Southeast Radio's Business Matters with Karl Fitzpatrick.
I'm now joined by a resident economist, Marc Coleman. Marc, we've experienced 9 interest rate increases from the European Central Bank over the past 12 months. But can we expect many more interest rate increases over the next 12 months, in your opinion?
I don't think we're going to get that intensity of rate rises over the coming 12 months. I think it's going to start tapering off by the middle of next year. And I think that the sizes of rate will go from 0.5% to 0.25% rises much more quickly. And they will be further apart. Rather than every 2 months, they'll be every 3 months. And they'll stop in the middle of next year. But the bad news is that the 9 rates you mentioned should not have happened with that intensity. I started work in the European Central Bank as a junior economist in 1997. My ultimate manager was a wonderful man called Professor Ottmar Issing. He set out a very clear, simple, workable monetary policy strategy, which envisaged a 7-year cycle where you would smoothly increase rates over 3 or 4 years as the economy was picking up and building up inflationary pressures. You would reach a peak and then you would spend 3 or 4 years bringing rates down in a nice gradual wave motion. That was all broken up by the global financial crisis. That was nobody's fault. But the problem was that we took too long to get back to that smooth policy approach. And when we did, and it was long after I'd left the European Central Bank, which I did in 2005, I think, the ECB took way too long to recover interest rates to the level that they should be. So they were kept too low for too long. From about 2014, we should have been beginning that smooth gradual increase, let's say from 2015 on, and then peaking for a year or two and then coming back down. Because we didn't do that, and for added reasons of the Ukraine war and also the pandemic, and government pumping a lot of money into the economy but actually restricting supply through pandemic controls, you got added inflationary pressure. Now, the response to that has been too brutal and too fast, in my opinion. And part of that was necessitated by inactivity by the ECB when it should have been gently raising rates. So am I saying that the ECB shouldn't have responded to the Ukraine war or the pandemic-caused inflation? No. But what I'm saying is they should have done a lot of the heavy lifting in response to other inflationary pressures earlier. So they've come up very, very quickly. Why have they done that? Well, Karl, I can only speculate that there may be political considerations going on here. And remember that ultimately the ECB is not just a monetary and an economic institution. It is also a political institution. And I'm old enough to remember the importance of the Maastricht Treaty in binding France and Germany together because they're the key pillars of the European Union. So Christine Lagarde, whom I've had the privilege of interviewing 3 times, she's not only a very formidable and intelligent lady, she's also a very political one. She was a former minister in the government of, I think, Jacques Chirac when I interviewed her first, and she went on, of course, to be head of the IMF. You don't get to those positions of having an awful lot of political clout. She's very well known to senior politicians in Paris, and she's very well known to senior politicians in Berlin. I better choose my words carefully, but what I'm saying here is that by increasing rates as fast as the ECB has done, and by peaking as I think it will in the middle of next year, it will enable the European Central Bank to start reducing rates quite rapidly into late next year and into 2025. What's beginning to happen late next year and 2025 that would make that important? You're heading into the French and German elections. And by increasing rates so fast now, it creates a positive headwind for the established governments in Paris and Berlin to face their electorates against a backdrop of falling rather than rising interest rates. And honestly, Karl, I can't prove that that's what's happening, but it certainly fits the facts, because there is no way that I, as somebody who's a trained monetary policy economist, I would never stand over inflicting the kind of pain that Irish mortgage borrowers, particularly Irish mortgage borrowers and particularly people in the domestic economy, were so exposed to interest rate increases here because of our variable rate mortgage culture in a way that the French and Germans are not. I would never have inflicted that amount of pain so quickly and so intensely as it has been done in the last 18 months.
Well, if you've just tuned in, that was our resident economist, Marc Coleman. And Marc will be joining us again on next Saturday's programme.
Southeast Radio's Business Matters with Karl Fitzpatrick.